taking an unconventional look at stocks, property, bonds, economics, and more. This is the Total Money Management Podcast with Steve Moriarty, Tom Hill, and Jacob Senior.
Welcome to Total Money Management. The week that was June 10, 14.
All right, Tom, we got to bag Steve out.
That's the first time I've introduced it.
First and last.
40. I think this is the 40th episode. Actually,
is it?
It will be. Yeah. Congratulations, gentlemen.
I've got a voice for radio.
You do.
Okay, folks.
Well
I'm in
done.
the driving seat, so I can talk about it. Okay, what are we doing this week? We've got party time, picking winners, not buying and holding, and we're talking a lot about emerging markets because they're cheap, folks. Emerging markets are cheap. So says the June newsletter, and so says the week that was. So what's the main point, lads?
Well, we're doing June 10 to 14 this week, kicking off with the big issue. And it's just a friendly reminder, most investors, particularly at peak euphoria, forget the yield and focus on the capital gains.
Exactly, Tom
Right.
boy.
Which is obviously very understandable. That's what you hear everyone talk about. I bought this house in 2021.
Yes.
You know, I've made $200,000 on it.
Yep.
It's way more exciting than going, this thing yields a positive $50 per week.
I'm losing $100 on this investment property. Cool.
Oh, I had I wouldn't say an argument, but an altercation with a gentleman on one of our various social platforms on the fact.
Unlike you, mate, you're not very argumentative.
That's a shock.
I'm very compliant most of the time.
So what was it about?
Oh, it was basically if you buy a house for $1 million and you sell it in 30 years for $3 million, you're having a party. And I said, yes, that's about a 6% return over 30 years, and it's shocking if you include inflation and taxes. That's the nutshell. I think people have this misconception that because it's such a large property is such a large amount of money over such a vast amount of time.
Yeah.
It feels like when you sell, it's
A lot of money.
It's a lot of cash.
Yeah. Schiller calls it the wealth effect, where, you get that, Granny bought this property for $30,000. Oh, my God, and we sold it for $1.3 million 40 years later. And when you do the calculations, you go, oh, that's actually a compound return of 3%.
It's a bit shit.
That's actually not that good. And that's why I say to people, you got to think in terms, even in property, that it's not that good of a long-term investment. It seems good. Right, it seems good, but it's not that good when you do the numbers.
But it's because it's the leverage, though, right? Because
Of course it is.
like if you had $10,000 and you bought that house for $100,000, well, you only needed to have 10% of that, and you're in the door, and then that asset has returned extremely well over that period of time. Now, it's easy to have that conversation in hindsight because at the time, no one could ever be certain that you're going to get those kind of returns. And if you look at the stock market traditionally, and you start with $10,000, then you'd have to do 30, 300x.
Yeah.
Absolutely. So,
But it's the thing of, again, if I value something now at the top of the market, it looks good, right? And that's, I've got no argument with that. But what I'm saying is you can't value something at the top of the market and assume that it's going to be that level 20 years hence.
Exactly right. You can't expect to buy something today for $3 million and have it worth $30 million in 25 years.
Exactly.
Yeah, which is what most people forget. They forget the cycles. And if you actually go back in time on property cycles, there are long periods of time where it's very, very stagnant. And usually the people that have bought at the top of the previous cycle are the ones holding through that nonsense.
The downtrend.
Well, mate, if that somehow happens, then you'd be staring down the barrel in 20 years' time of buying an absolute dump in Stafford on a main road for $3.5 million.
Yeah.
You know?
So your wage would have to be about $400,000 a year.
But that's the point.
It'd have to be probably
Right.
like 700.
It can't continue on forever because at some point there's no income left to pay for it. And that's what we're starting to get to now, right, with the rate rises. Now, just to give you an idea, Melbourne land boom, late 1800s, right, 1870 to about 1890, prices go crazy, right? When it stops, it doesn't recover until 1952. So that's 60 years it went nowhere, right? And that's what I'm saying. I'm not saying this time it's going to be 60 years, but what I'm saying is like it's the same with stock markets, right? It's the same with property markets. It's the same with bond markets. When you start talking about the capital gain, that is absolutely valid. but you only get the capital gain when you sell. It's the same with a stock. If it goes from $1 to $2 and you start saying, look at me, Mr. Smarty Pants, I made 100%, then it falls back to $1.20, which is its real value. You sort of look at it and go, oh, actually, now I'm only making 20%, right? Because you didn't get the capital gain. And that's the problem with property. You can't make 200,000 and then go, I'm going to sell and collect the 200 profit, right? You've got to sell the whole property.
Well, don't a lot of people, look, I'm not arguing, by the way. I'm just curious. Don't a lot of people just cash out the equity? So if they've got 200K equity in a house, for example, the bank will go, cool, like we agree that this is how much it's worth. I'll let you take 150 of that out.
Sure, but what happens in 5 years when the property goes from $1 million to 800?
Exactly.
You see, you're not
100%.
You're not cashing out. What you're doing is you're borrowing against the value.
Yeah.
Right? That's the problem. And that's what happened in the US in the GFC.
But that's effectively what has kind of put so many people in a position where they've now got multiple properties.
Absolutely.
Absolutely. They're just leveraging up.
Yeah. So it'll be catastrophic if it does turn down.
Well, the party's been amazing if you attended 10, 15 years ago. Getting in now when everyone's going home and they're all a bit drunk and wobbly might be a bit, we're saying it's a bit dangerous.
The easy money's been made, right? And that's what I said with my own story. I bought property in 2000. I did really well, right? Why? Well, it wasn't because I was a genius. It was because property was cheap in 2000. And John Howard halved the capital gains tax. There was incentives there. The other thing was, which a lot of people don't realise, is there was a huge change in the Asian financial crisis where a lot of money came to Australia with the mining boom, and that sets it all off. Right? And that's why I'm saying it doesn't go on forever, and that's where you get the big gains, but unless you sell, those property markets like stock markets mean revert, right? And like you just said, Jacob, 2018, Josh Frydenberg was interviewed, right, about Sydney property, and he said, well, I expect it to double over 10 years. Okay, so you think about that. By then it was already at about 1.3, I think. So what that was saying was he expected the average Sydney property in 2028 to be $2.5 million. Now, if it goes up 10% per year, right, in order to pay for that, to match it, your income would have to go up 10% per year. Right? Well, wages have gone up nowhere near that on average. And so that's why I'm saying what you're seeing is just this enormous growth in debt. And from that debt, your income falls because you've got to pay more and more of it to pay back the loan, right? Which leaves less for the economy, which leaves less for economic growth, which means at some point you start getting unemployment rising and property starts to fall. Right, that's the way the cycle works. It's just that we haven't hit that peak yet.
So we've just got to tell all our bosses that they just need to double our wage every 7 years, and
to keep up with property.
It'll be all right.
Or you invest in the right places and you'll be fine again. So as an investor, we want low prices, high yields, not sky-high record prices and yields that can't even match the risk-free term deposit. That's the moral of the story.
Yeah.
You need to learn what a yield is, and then that's what we need to focus on.
You've got to find a bargain.
Yeah.
That's the way, Warren Buffett.
It's not easy.
Well, Warren Buffett finds bargains.
Yeah.
Right?
And if you want to find a bargain, come and talk to us. That's what
and
we
be
should be telling
patient.
People.
Right? Wait for the good times.
Bargain hunters.
So, yeah.
Monday. It's extremely difficult to pick a 30-year winner. So the chart that we're looking at here, and you can go on the socials or whatever and have a look at it as well, but it's basically saying the changes in US stocks in each decade and who are the big dogs and who aren't. So we're saying it's really difficult to pick something and hold it like Coca-Cola for 40 years like Buffett would have done when there's so many changes throughout the decades.
Well, you imagine at every start of those decades, everyone would be saying what they're saying now about NVIDIA and, the leaders of this decade.
Apple, Microsoft, NVIDIA.
Well, in 1930, it was AT&T, General Motors, General Electric, Exxon, Marathon Oil and DuPont. They were the top five, right? And AT&T works for as the top one for 30 years. I don't know what the return was, mind you. But then, AT&T now is about $15 or last time I looked, the stock price was terrible. But what I'm saying is when people say to you, these are Warren Buffett's traits that you can emulate. There's a study done by a guy called Professor Bessenbinder, and what he showed was your chances of picking a winner is like minute, right? And the reality would be you'd look at it sensibly and go, you shouldn't even bother, right? Because it's just so hard, and it's even harder if you're told, oh, Tom, you got to hold it for 30 years to compound. It's like, okay, well, none of them stay good for 30 years. Right,
What
very
stands out
few.
here for
Very
me-
few.
Yeah.
Absolutely.
Well, you got General Electric, which is probably the longest standing one from 1930 to the 2010 decade. And what that says to me, if you bought in 1970, you might have done all right.
Yeah, but that's 50 years.
Exactly, yeah.
So, and that's what I mean. That means you'd have to be roughly at 70 years of age. General Electric's been a dud for 10 years or so. So again, it's this idea of, buy and holding a single individual stock is an enormous risk.
You need to rebalance.
And it looks risk-free when it's at the top,
Yeah.
right? How could you not say Nvidia is going to be worth an absolute mozza in 10 or 20 years? And it's like, well, I can't. You might be right. However, just looking at history shows you that they don't stay on top forever.
This puts it right into perspective. We got 2000, Microsoft came up on the board, in 2010, obviously 2020. Apple only in 2010. It feels like they've been around for hundreds of years, and obviously they haven't. And Amazon, Google, and Facebook are not even on the chart yet.
Yep.
So go on by this. Apple's got another 10 years in it.
Oh, Uncle Warren hopes so. What do we got? What else have we got? Gentlemen?
ASX, I felt like a dickhead when I sent you guys a message that the ASX had gone down 8%,
8%.
and it was the wrong ticker. And I genuinely thought the ASX was having a nightmare. And
It was the company you meant,
It was the
wasn't it?
company,
Yeah.
And no one was talking about it. I thought I got in there early. And I was like, lads, the ASX is down 8%, 10% in 2 days. What the frick
You were just
are we
watching
doing?
the ticker?
And I was just watching the company ticker. I felt
Not
like
the
a
market.
right dickhead.
Right.
Tom messaged me.
You gave me a heart attack, mate. I quickly logged on to and I was like, oh, okay. Jacob's
That just proves how tired I was.
Jacob's on another planet.
In another city, as the case may be.
And Steve wrote to you and said it's the stock, followed by some
Did he?
I
words.
may have given some candid feedback,
Mate,
shall we say.
I didn't even read that. I didn't read that. And then
That
checked it
involved
again.
a relative. But what we're talking about, folks, is basically the business confidence survey came out and it's gone negative. And so if you're looking at Australia's economy for the next 6 months, it's not looking very attractive because business have gotten less confident and it's deteriorating. Consumer confidence is okay, but I think generally it, to me, and I could be wrong, but to me it just, we're getting a bit of what this lady in the United States calls the vibe session, right? Like the recession. There's a bit of bad
Stop
vibe
that.
about
I hate
things are not going that well.
I don't like
The
that.
vibe session.
I know, but mate.
But now that they've come
you gotta
out and
have a
said
catch.
it, businesses are probably going to go nuts now.
Why?
Well, the media's said that business confidence is down.
It's opposite day. Well,
Follow the money. Where's the money coming from? The government's we've got a surplus this year from government, and private sector people are borrowing, but not much. So you've got to get money into the economy to drive corporate profits and, wage rises and all that sort of stuff. Well, if that's not coming in, there's
Immigration.
But immigration still doesn't add that much to the economy, right?
No, we're saying we're going to fall into a recession, but it feels like we're already there by all accounts. We're teetering on the edge of it anyway.
I think it depends who you speak to be quite honest. I think it's, like if you speak to people like me who get 5% on cash, we don't care about a recession. But for other people, it can be a lot harder because the lower income earners are really struggling.
Well, everyone's whinging about how much everything is costing at the moment.
Much everything comes. Are you whinging?
Costs. All right, mate. All right.
It does. It does.
Dear.
Things are expensive. Petrol's $2.30. I mean,
I paid $2.51 this morning.
did you really?
Are you putting in gold infused petrol
Yeah, what'd you do,
Gold
mate? Hit
flakes
the
in there.
premium unleaded.
Yeah.
in your Ferrari?
No, mate. That's just what you
Righto.
do.
What do we got next,
Look after
gentlemen?
your things. Wednesday, Turkey imposes a 40% tariff on Chinese EVs. So Turkey have come to the party and went, you're not going to flood our market with these.
Yep.
So this
Yeah,
just
yeah.
continues that story. You probably don't have to spend too long on this, but it's just interesting to see, right? More and more people are...
Well, more and more countries. This is Europe has responded to this week to Chinese EVs by saying we're going to put 40 to 50% tariffs on it. Turkey is saying we're putting 40% tariffs on it. I think last week we talked about Brazil and India and someone else putting tariffs on imports of Chinese steel. So what I'm trying to say to people is this is not gonna stop, right? We are now in a full-blown trade war. It's just at the moment we're trying to appear like we're all reasonable, but it's not going to happen, right? China has become such a problem for the global economy that now every country is basically saying, listen, we're not having you guys come in and wipe out our industries like you did to Australia and America and England. We're not going to be hollowed out like that, and we will use tariffs.
Will this affect the 5 or 10 year performance on emerging markets, though? Because emerging markets are really cheap at the moment. But if they're whacking all these tariffs on everything, and it affects their ability to export profitably, which is where most of their cash flow and capital comes from, are we going to see...
Well, we will probably see, as we've talked about in the new normal, we'll see more government intervention and more government direction of where the money will be, where the capital will go. So the US is now embarking on building their own semiconductors, right? Now, the Chinese don't have access to the creme de la creme of semiconductors. Now, that's going to be a real problem for the Chinese.
They'll figure it out.
Nuh-uh. This is not building houses, mate. This is building chips, advanced microchips. Now, let me give you an idea. The Chinese can build, basically the most popular one is 27 nanometers, right? TSMC in America at 2, right? So what I'm saying is 27 is a chip that you stick in garbage like vacuum cleaners, right? It's not stuff that you put in bombs, right? Or use for AI. And so the let me inverted commas, the West is way ahead of China. That's why China is scrambling. If they weren't, if China went, we'll do this ourselves, you wouldn't be hearing from them, right? But you're hearing from them because they know it's seriously going to hold them back, and they've got to try and find their way to do it. Well, that's what I'm saying. We've got a full-blown trade war. It's going to get worse. Right, but if you listen to what are the arguments at the moment, a lot of economists are saying, tariffs are really bad and, protectionism's really evil. Welcome to the real world, boys. It's about politics, right? And this is what I'm saying. The market has been dominant for 40 years because everybody's been making money. When it comes to national security, that's a completely different issue, and it's not an issue of economics. We should help make the Chinese rich. So they can bomb us. Yeah, that'd be a really good idea. Well, that's a stupid idea, and that's what I'm saying. The economists are still going, we should allow cheap electric vehicles. Let's be honest. If I said to you guys, listen, I tell you what, we can let China's cheap EVs in, wipe our industry out, right? And we can either do that. And now the important part is in 20 years they may invade Northern Territory and, create a war. You guys would be going, is there any alternative to the electric vehicle? It'd be simple. In America, they just say, all right, well, we'll just ignore EVs and we'll build hybrids, or people can get petrol cars. Do you see what I mean? Like it's not as if you say, mate, if we don't have Chinese EVs, we're going to have to walk everywhere. No, we're not.
No, just build your own.
Well, yeah, or Tom, Jacob, as I said, they'll say, well, just buy a petrol car like you have for the last 100 years.
Yeah.
Yeah,
And
but-
people go, oh, that's terrible for the environment. It's like, okay, well, do you want to do that? Or do you want to build up the Chinese military by allowing them to, by buying their EVs and supporting their industry?
Yeah, but there's still
That's-
like the net zero initiatives and things that we're all getting to by. Well, we all have to get to by. What is it, 2050?
Yeah, but I mean, I hate to be a stick in the mud, but
No, you don't. You love to be.
I
a stick
do
in the
love
mud.
to be a stick in the mud. But seriously, you hear this all the time. Australians are really concerned about the environment. Really? Go and have a look at how many people are driving an SUV that's got a thumping 3-litre V8 in it.
Yeah. No,
I
I'm
mean,
saying that-
honestly, you've got to call it out, haven't you?
yeah, what I'm saying is that that's a reality, though. Like, there is that initiative that we've all
But nobody's-
countries have said they're going to get to by whatever 2050 or 2060, whatever the number is.
Jacob, I did a science degree in 1990 where we talked about ecologically sustainable development. Now that's 35 years ago, a little bit longer, right? Here we are, we're still talking about all this garbage and nothing's really changed, right? We're still hacking at the land, we're still selling lots of coal. And if you look at solar and wind and batteries as a percentage of world energy markets, it's like 3%. Right? It's a slither. And it's, we are not, whether it's right or wrong, we're not going to get any of those targets. And what I'm saying is, when you say, oh, well, we should import Chinese EVs because that'll help us get the target, all of Europe's going, hang on, dude, my job depends on me being at the car factory. Bugger the environment, I want a job. That's the choice, right? And that's where it's easy to have statements like, oh, we'll be net zero by 2050, but you have to say, oh, well, Jacob, what that means is you'll have to take a bit of a pay cut, mate, and pay more for this. You'd be going, hey, hang on a second, right? And that's the reality of it.
Well, the reality is it's a government decision and it feeds into the big government conversation that we're having. They have committed to net zero. The people haven't. That they have.
Yep.
So we're going to achieve net zero by 2050, and these are all the things that we're going to do. And to do that, it only feeds into one tiny point that we were talking about. Instead of importing Chinese EV vehicles, we just make our own.
Yes.
Or we import the batteries
Yes.
from a non-Chinese country and make our own.
Well, everybody's doing what countries are doing is making allegiances with fellow travellers, right? So we're under the American umbrella, and there's countries under the Chinese umbrella, and there's countries that are trying to work out who the hell they should be dealing with, right? And that's what's going on at the moment. We're just in that phase where we're trying to sort out the two sides.
Yeah.
Right? And we said this 18 months ago. Countries have to pick a side. America's not going to support you if you're supporting the Chinese.
Yeah.
And the big problem with EVs and AI and information technology is you can't support America but import Chinese products, because Chinese products will gather the data. Right, that's the oil these days, is the data. That's the gold. And so the problem with Chinese EVs, or any EV, is they can track every single one of your movements. It's like the smartphone. They know where you've been. They know what you buy. They know what's going on in your life. They're right through your socials. An EV isn't a computer on wheels. They know where you drive. They know how fast you drive. Where you're going to. That's all really, really valuable data.
Where you sleep.
Absolutely. Absolutely.
Whether you're wheezing or not, Steve.
Sorry, I can't help it.
Thursday, look, it's a timely reminder that, again, that we're talking about the CAPE ratio being our primary indicator, and that the fact that it is extremely overvalued at the moment. And it has such a strong correlation with 10-year returns. So at the minute, CAPE ratio is what, Steve? You've probably got the back of your head, 34?
34.9 or something.
Yeah. So the next 10-year returns are expected to be 4%, 3%. Slow.
Yeah,
Slow,
2,
Paul.
1.
Yeah. And although that we advise that you use multiple indicators to help you with your investing decisions, this is one that you definitely should go on just look into. Do a bit of reading. Go on our website. We've probably got plenty about it there as well.
Yeah.
Well, yeah, this is the thing, right? We can't go through everything because it won't make any sense. But again, go look at the week that was. We've shared a number of different indicators, and they all just look batshit crazy.
Yeah. That's the sort of you can get one indicator that's a bit of an outlier, right? But when you look at it and say we've got 10 measures of value and they're all expensive, you go, it probably means things are expensive, right?
That's when most people put those in the drawer and go, let's focus on the story.
But Bob says NVIDIA's going to be going forever.
Have you heard of artificial intelligence?
Big time, Bob. And then Friday is a perfect example of why you shouldn't listen to financial analysts. We love bagging the analysts.
The headline is S&P 500 returns are worst when analysts are most bullish.
Yes.
Oh, and they're the best when they're the most bearish.
But, yeah. But that's why I said, Tom, before, like when you talk about property and stuff like that, at the peak, everybody's bullish, right? Because it's been going great. But investing is not about the past. It's about putting your money down now and saying, what do I get in the next 10 years, not the last 10 years.
Yeah.
And we often make the mistake of saying, but the last 10 years, and I think I said this a few weeks ago, when you buy a cape of 10, that's a hell of a lot different than buying when the cape's at 35, right? And you wish you'd have bought at 10, but it's 35.
And the trouble is when the cape's 10, everyone's going to be telling you how bad the stock market is.
It's never going to
Everyone you talk to has lost a lot of money in super. You're only going to hear the horror stories.
It's rigged.
You're not going to. It's not going to feel comfortable.
Yes,
investing there.
Well, look at the Royal Banking, the Banking Royal Commission a few years ago, right? A lot of the people who submitted, there weren't too many people submitting it going, man, I have killed it. This is fantastic. Everybody was submitting it going, the banks ripped me off. They shouldn't have given me $1 million, And it was like, I'm sorry. So you went to the bank. What for? Did they drag you through the bank and force you to sign to take $1 million? They were the people who lost money. Right? That's what I mean. They were the people who lost money, but you don't.
The bank said it's a business at the end of the day. Well, can you afford it? Yep, there you go. Can you afford it? All right, tick.
Yeah, and if you, how many people go to a bank and say the bank wouldn't lend me some money? Okay, that's it. I'm not going to borrow. No, they don't. They just go to every other bank until they find someone who'll give them the dosh.
Yeah,
right. And I know that from family experience. They went, "You're not getting any money," and then they went, "Okay," so they just went elsewhere and secured a loan.
Yeah, it's interesting. Right? March 2009, when analysts were the most bearish, was the most profitable. Or basically the better returns over the next 10 years. Yeah,
March the 9th was the bottom. March 9, 2009, that was the absolute bottom. And from there, it's been, you've made, I think it's about 14.5 compound. So not a bad spot.
What's that, doubling your cash every 4 and a bit years?
Well, yeah. Well, in 82 to 2000 was about 16%. So rule of 72, that's basically doubling your money every 4 to 5 years.
Yeah.
So you go from 100 to 200 to 400 to 800.
Yeah.
That's, that's why I say to people, you only need one good recession, right? If you get in at the market and you go big when it's low, man, oh man, you don't need to do too much. And like I say with property, right? If you bought in 2000, you've absolutely, not totally, but most people have absolutely smashed it out of the ballpark because that was the low point.
Yeah.
And that was when the banks have opened the spigots and the money's been flowing in. Right?
Spigots.
Spigots.
What's a spigot?
Oh, you're in healthcare,
you
aren't
learn
you?
something new every week with
you don't know, seriously, you don't know what a spigot is.
I don't know what a spigot is.
Holy dilly. Righto, folks, English lessons from next week.
The bonus section for this one we actually covered off last time. It's just about government looking to extract the surplus value from property and investors. We made some commentary around the Airbnb. Government's cracking down on that and other things.
Yeah. It's just what I'm trying to highlight there is when you have an outsized return and there's a portion of the community who are saying we're being unfairly sort of discriminated against, right? Renters, lots of renters are complaining. You hear lots of stories of complaints. And what I'm saying is politically governments will respond to that. The problem they've got at the moment is they know that if you go and say, well, actually what we'll do is we'll reduce negative gearing, everybody with negative gearing is going to go, right, we're not voting for Albanese, right, because they learnt that lesson with Bill Shorten. Shorten said, we're going to do this, and they went, right, I'm not voting Labor. So Labor went, right, that's the end of that. And that's why I say it's quite tricky, because basically what the government is doing is going, man, we're just going to, I don't know, we'll try to build more houses, and if it all falls apart, thank Christ, because they won't blame us, they'll blame the RBA, or, there'll be a worldwide recession, so we'll get away with it. Because, governments are saying we want affordable housing. They haven't said we want to make houses a lot cheaper. Because if you're an investor, you don't want to hear some bloke on the telly going, your $1 million property, we'd like to get it valued at about 700. It'd be like hell.
Yeah, that's a good point.
Well, if someone came to me and said, Steve, you've made a lot on these stocks. Listen, mate, what we'd like to do is reduce the price of them 30%. I'd be going, get lost. Right?
No, thanks.
Yeah. What? Because someone else hasn't got stocks? That's their problem, not mine. Right?
Yeah.
That's what you do.
All right, let me
chow.
Let me end on the chow. So just for some perspective on craziness, over the last 32 trading days, Nvidia has gained more than $1 trillion in market cap. And to give you some perspective, listeners, the 6-week gain is greater than the total market cap of Berkshire Hathaway, which is Buffett's company.
He's only spent 6 decades building that.
That's 6 decades worth of Buffett work. And Nvidia in 32 trading days has gained more than $1 trillion in market cap.
Nvidia?
So you know what the moral of the story is? Warren Buffett's a loser.
Yes, buy Nvidia.
Loser. He
No,
buggered
don't buy
around
it.
for 60 years when he could have nailed it in 6 months. He's a dud.
32 days, mate.
22, what is it? 20% compounding for 60 years.
32 days or 6 weeks, mate, not 6 months.
Mate, you got a YOLO. You got a YOLO.
weeks.
It's crazy, isn't it?
It's absolutely insane.
But I can tell you, there'll be, in a few years, we'll be sitting back going, oh my God. Because that's what it was, as I say, I've been there before.
What's an Nvidia?
Yeah. Remember that stock Nvidia? What was that? Oh, Intel was the last one, I think, in 2000. That was the one that, went through the roof.
And then went
And then, like you said, Tom, stairs up, elevator down. In this case, it's elevator up, elevator down. As I say, this is the benefit of understanding market cycles and valuation and history, right? Because you get old enough to go, yep, seen that before, because it's not new.
It's gonna be crazy when it unravels.
Absolutely. And
It's gonna bring everything. It'll probably really affect everything.
Well, it always does.
Yeah,
it always does.
but this is nuts. So, all right, I think that's a wrap, hey?
Yeah,
that
let's call it. To see you next week, gents.
Thank you.
Cheers, folks.
Stay up to date on our socials. Just search for Total Money Management on Instagram and TikTok. For your free investor personality assessment, go to totalmoneymanagement.com.au. And as always, remember, we don't provide financial advice.